working capital क्या होता है? But there are certain requirements which are just to keep the business afloat, right? You'll put something in that showroom, right? So you'll buy that inventory. Let's say mobile store. You'll buy a lot of mobiles. That's your inventory. Or if you are, let's say, a manufacturer, you'll buy raw materials and you'll manufacture something that is also part of your inventory that will be with you, and you'll have some amount of money that you've made a sale for, but you've not received cash, so that will be your receivables. So all of those things. Correspondingly, on the liability side, you might procure raw material. Suppliers say you're getting some mobiles and paying them later, so you'll have some payables, right? So your all of your current liabilities and current assets, basically, which are taken care of within a year, they basically define your working capital, right? So your current assets minus current liabilities is your working capital. In this case, 9 lakhs minus 8 lakhs, 1 lakh is your working capital. What that shows is that you can still be afloat, right? Current assets are more than your current liabilities. So liquidity for running the business is not a problem. Since it's about the liquidity of the company, this is also denoted as one of the ratios, which is the liquidity ratio called the current ratio, where current assets divided by current liabilities tell you about the current ratio. So it's the same basically, 9 lakhs upon 8 lakhs, so the value would be more than 1, right? So you know that you are safe. So between a range of 1 to 2 is enough. More than 2, sometimes you'll think, I have a lot of assets, am I sitting on a lot of cash, not utilizing properly, and all of those things. And if you are below 1, or if you're saying, let's say it's a negative working capital where the liabilities are more than current assets, you need to analyze it further and check whether even the liquidity of the company is at risk or not. Can you even do business? So we'll discuss that. But before that, I want to introduce one concept, which is a very important concept in business. It's called cash conversion cycle. Yeah. Now, from a business standpoint, just look at this. What would be a typical journey if, let's say, you are a manufacturer or you do some business? You will buy some inventory, right? You will call a supplier and say, send me 10 cell phones. I want to keep it in my showroom, right? He'll say, okay, I'm sending, but within 7 days, please make the payment. So after some time, you'll make the payment to the suppliers, right? Now those things are kept in your store. One day a sale will be made to the customers. Someone comes and says, I need 3 iPhones, I'll take it, but I'll pay you day after tomorrow. So you say, okay, take it, 3 दिन के credit पे लो, then give it to me. Then your cash is received from the customers. This is a typical, very simple to understand cycle, right? Now, what's happening here? When you take the inventory, right? From that day, your inventory is in your store, and then you make a sale. So you've been holding that inventory for this time. It's called days inventory on hand, right? DOH, or inventory days. Now there's one more thing where you made a sale to a customer, but you are awaiting the money. This is called days of sales outstanding, DOS. Itne din tak your sales were outstanding, you did not get cash. All of this is in respect to just cash, where you made a cash payment, right? There's one more where you see that you placed an order for that inventory, those cell phones, but you paid the suppliers after some time. This is called days payable outstanding, right? Now, what is the cash conversion cycle? You paid cash at this point to the suppliers, right? But you received cash at this point. So the number of days between this is called the cash conversion cycle. How much time does it take for you to convert the cash from a purchase to a sale is the cash conversion cycle, right? Now, in simple terms, what does this mean? Your total inventory days plus your total days of sales outstanding minus days payable. So you'll get the cash conversion cycle, right? How do we do this? Inventory turnover. Abhi inventory turnover hai kya? How do you in real life calculate inventory turnover? This is not just one transaction for you, right? You're not just buying 10 cell phones and doing this for once. This will happen over and over again, every day, right? You'll be placing some orders. Someday you'll be paying back. Customers come to you daily. किसी ना किसी का पैसा daily वापस आ रहा है. This happens throughout the year. So how do you figure out that what was my inventory holding period, right? It is not one transaction. How do you figure this out? What you do is very simply, what you do is COGS. You look at your COGS, cost of goods sold. पूरे साल के end में you'll have your P&L, you'll have cost of goods sold mentioned there, right? You'll know your average inventory through the balance sheet because balance sheet has inventory number on it. So average कैसे लेना? You'll see the start of the year, end of the year, divide by 2, take average inventory. So let's say your COGS, let's say in Mohit's example, it was 7 lakhs of the cost of goods sold. We are not taking the selling price. This is not sales for a reason. We are just looking at inventory because inventory you have bought from the supplier. Supplier से जिस price पे आपने खरीदा है, that is cost of goods sold. You are not selling it to the customers yet. जो जेब से कैश गया है, that has gone at the cost price of the goods to the supplier. So cost price of the goods to the supplier, right, divided by the average inventory would tell you कि inventory कितनी बार turn होती है आपकी. So average, let's say, is 3 lakhs only. I'm not going back to the example, but this tells you that the inventory was turned 2.3 times. So basically, whatever inventory you have at any point of time in your store, you are able to churn it 2.3 times in a year. Now, how do you calculate inventory days from it? 365 divided by 2.3. How many days does it take to turn over once? 158 days. What does this mean? That you keep inventory in your store. It takes 158 days for you to sell the inventory from the day you procure it. Now, what is receivables turnover? Similar, right? You look at, instead of COGS, you now look at sales. Why sales? Because now we are talking about customers. So जो value होगा, that will be the selling price. So you look at sales, overall sales made in the year, in the P&L, you can look at that value, calculate the average receivables just like we did for inventory, right? And then you see the receivable turnover twice, right? So the receivable turnover is twice. Now, days sales outstanding, again, the same methodology, exactly analogous, 365 divided by 182. What does this 182 mean? That it takes you 182 days, right, to get the cash back from the time you made the sale, right? It's pretty high, but there are certain businesses where this will be the nature of the business. Similarly, payable turnover. कितना दिन लगता है for you to pay your suppliers, right? How to calculate this? We again move back to COGS because you're talking about suppliers. COGS divided by average payables, right? So you'll get the payable turnover. कितना turn होता है? How many times does it turn in a year, right? So COGS divided by this 3.5. Again, same formula. Days payable 365 by 3.5, 104 days. Now you have all three values with you. All of this can be found from the P&L and the balance sheet. For the balance sheet, just take 2 snapshots and average them, start of the year, end of the year, right? Now, if you look at this example, 158 days, right, of inventory, this plus 182 days, which is your days payable, minus days outstanding, payable outstanding, 104. So your cash conversion cycle is 236 days. It takes you 236 days from the time you pay cash, right, to your suppliers and you receive cash from your customers. It takes you 236 days. Similarly, like a cash conversion cycle, you'll have working capital, like working capital turnover. What is working capital turnover? If you looked at inventory turnover, receivable turnover, payable turnover, working capital turnover is the same. You calculate the working capital, right? Net working capital, which is, we just read, it is current assets minus current liabilities, right? Which was 1 in that case, and the sales made were 10. So the working capital turnover was 10. So the working capital days were 365 by 10, which is 36.5 days. Now I'll do that with an example, right? Like CFA fluid control, I've been talking about this talk a lot. It's working capital. Let's see what it is in real. What is its working capital? Current assets minus current liabilities. We just read that. Its current assets minus current liabilities on the balance sheet is showing 114 crores. So we know working capital is current assets minus current liabilities, 114 crores aa gaya, right? Let's see what is the working capital turnover, right? 146 crores was the sales made, right? So the sales divided by its working capital will give you a ratio of 1.28. So we know that this working capital is turned over 1.28 times in a year. So we can calculate working capital days, 365 by 1.28, we got 285 days. Also, let's look at its cash conversion cycles, inventory days, receivable days, payable days, all of this is calculated for CFF, it is 433 days. It takes CFF 433 days, and which is the highest here, their receivable days. 376 days it takes for them to receive cash once they make a sale to the customer. Obviously, it's into shipbuilding, right? Inventory days are also high. So 433. Now let's say cash conversion turns kitna hota hai? 366 by 433, 0.84, right? Obviously very high, very low turns. That means very high cash conversion days for this. The idea of this whole activity is to figure out that how much sales can you make, right? How much sales can you make with the existing working capital that you have, right? How many times do you turn it? So for example, let's say CFF sales in FY25 was 146 crores, right? Now I'm estimating that its sales in FY26 is 250 crores. That this is my estimate that next year in key sales 146 to it will go to 250. Now let's say working capital days remain the same. Now the management is not able to improve the receivable days. 433 days mein aa raha hai. It is not able to improve its days payable. It is not able to improve its inventory days. ये सब values उतने ही रहते हैं. Let's assume, right? So the working capital days will remain 285, right? So working capital turnover again will be the same, 1.28. Now, how much sales can be supported is a factor of working capital into the working capital turns, right? So working capital is one thing, its turnover is completely a different thing. For example, how much cash is stuck in the business, right? How much of the cash, or let's say how much of the capital is stuck in the business? 114 crores of working capital spent is stuck in the business. For how long is it stuck? That is the main game, right? You could be really positive in your working capital. Your current assets might be really great than your current liabilities. That subtraction will always give you a high positive value, let's say. But if your rotation is not fast, right, it will not make a difference because you will need to infuse more and more capital in the business because you're not able to rotate, right? You have a lot of cash. It's like you have a very big fuel tank in your bike, but you're not able to rotate it again and again. So you can only you consume that tank once. So if you have a 500 liter tank also, you can just consume it once in a year. So you can only move 500 kilometers. But if I have a 250 liter tank also, but if I'm able to churn it 5 times, I'll travel further than you, right? So that is the whole game. So how fast can you churn this? If I look at CFF and if I want to make a comment that let's say sales kitna support karna hai. Next year I need to support 250 crores of sales. My days are not changing. So my turns will also not change in that year. So I'm able to turn it only 1.8 times, 1.28 times. So my working capital requirement would be 250 by 1.28, which is 195 crores. Right now, its working capital is 114 crores. So very clearly, it is working capital requirement will be more next year. How much more? You subtract this, you'll get 80 crores. You are in 80 crores deficit. So either this working capital, if I don't bridge this 80 crores, if I don't fund this 80 crores, what will happen? My current assets will be lesser than my current liabilities, and I'll have a negative working capital, which could mean that my liquidity is stuck. And doing day-to-day operations might also be difficult for me. I might not have enough cash to pay salaries to my vendors and to my suppliers or utility bills and all of that. I can't do all of that. So my operations can get stuck. So if I have to maintain this 1.28 times turnover working capital ratio, or let's say I want to have a positive working capital, I'll have to infuse 80 crores more, which will either be a loan probably from a bank, or I'll infuse it through equity. In both the cases, the returns will suffer. Your ROE will get reduced. So what you have to really understand is the management able to maintain the cash conversion cycle? Are these days reducing? You do not want these days to go beyond a certain point, right? Your cash has to convert really fast. Cash. How big is your working capital currently? And are you able to turn it quickly? These two in combination will decide what is your working capital requirement. Do you need more funds to grow the business or not? You can go and negotiate that, now I can't give you credit for more than 10 days. I'll give it only for 5 days. Amount will remain the same, but now only for 5 days. So if you have such negotiation powers, you will reduce your overall days that means you'll have more turns. When you have more turns, even if your working capital, you need a lot of working capital because of this ratio changing, right? You might need lesser value, and less infusion of funds will be required to fund your day-to-day operations. So now let's say 80 crores, I know for a fact that 80 crores more is required. So I can make that adjustment in my calculation to figure out whether, what sort of a profit it will generate, PAT, at the end of the day for CFF.